Union Budget 2026 was announced on 1st February and no changes have been brought in tax slabs or tax rate, whether under old regime or new regime. This means that the tax slab specified for financial year 25-26 will continue for financial year 26-27 as well. As before, new regime is the default option for taxpayers. Old regime is available, but you will have to opt out of the default while filing your income tax return if you prefer to choose old regime. In the following slides, I will compare both the regimes and will try to see which one may work better for you. Let us first look at the tax rates. Basic exemption limit is 2,50,000 under old regime and highest tax rate of 30% is applicable if your income crosses 10 lakhs. Whereas in new regime, basic exemption limit is 4 lakh and the highest tax rate of 30% is applicable only if your income crosses 24 lakhs. Surcharge is applicable under both the regimes, but highest surcharge is 37% under old regime if your income crosses 5 crores, whereas in new regime it is limited to 25% if your income crosses 2 crores. Health and edu-cess is applicable under both the regimes. Rebate under section 87A is available up to rupees 12,500 under the old regime. As a result, individuals with taxable income up to rupees 5 lakhs need not pay any income tax. Same rebate under section 87A is up to rupees 60,000 under new regime. Consequently, individuals with taxable income up to rupees 12 lakhs need not pay any income tax. It is evident that tax rates are comparatively lower under new regime. So can we say that new regime will always be beneficial for us? Maybe not. Although tax rates are lower under the new regime, deductions available under old regime are much higher. In the below table, let's see the deductions available under each head of income. For income from salary, standard deductions is rupees 50,000 under old regime, whereas this is 75,000 under new regime. Deductions like for HRA, LTA, profession tax and all are there under old regime, but it is disallowed under new regime. For income from house property, interest paid on housing loan for self-occupied property is available for deduction up to rupees 2 lakhs under old regime. This is not there under new regime. For income from business profession or income from capital gain, deductions are same under both the regimes. For income from other sources, deduction for family pension is limited up to rupees 15,000 under old regime. This is available up to rupees 25,000 under new regime. Chapter 6A deductions are the place where major difference comes. Deductions allowed under Chapter 6A under Section 80C, 80D, 80D, etc. All these are allowed under old regime, but most of it is disallowed under new regime, except a few like employer's contribution to NPS under Section 80CCD2 and all. So these deductions will lead to tax benefit under old regime, and we can understand this better through a practical example in the following slide. In both our examples, taxable person is salaried individual with gross annual salary of rupees 20 lakhs. In example 1, he has total deductions of rupees 8 lakhs to claim under the old regime. Consequently, his income tax comes to rupees 1,72,500. Under new regime, his total deductions are rupees 75,000, which is the standard deduction allowed to salaried individual, and hence his income tax payable is 1,85,000. So here we can see that old regime is beneficial for him because of the higher deductions. In example 2, his deductions are limited to rupees 2,50,000 and hence his income tax payable becomes 3,37,500, whereas under the new regime the income tax payable is 1,85,000. So here the new regime is beneficial for him. So whether old or new regime will be beneficial, this also depends on the deductions one plans to claim. We also need to discuss limitation on switching, which impacts our decision to select a regime. Those earning income from business or profession can switch between old and new regime only once in their lifetime. From financial year 23-24, new regime is the default option. To opt out and move to old regime, those having income from business profession must file Form 10 IEA as per income tax rules. If a business owner opts out of new regime and adopts old regime, they are allowed to switch back to new regime only once more in their lifetime. However, once they switch back to the new regime after opting for old regime, they are permanently locked into the new regime and cannot go back to the old regime again. Hence, for those with business or professional income, the choice is strategic and long term, as opting out of new regime limits their future flexibility. For salaried individuals and all other taxpayers other than those having business or professional income, they can switch between old and new regime every financial year while filing their income tax return. Hence, while tax rates are higher under old regime, taxpayers also benefit from a wide range of deductions and exemptions. The new regime, on the other hand, offers lower tax rates but restricts most of the deductions. For income up to rupees 12 lakhs, the new regime is more beneficial due to rebate under section 87A. For income above 12 lakhs, the choice depends on the quantum of income, deductions and exemptions one is eligible to claim, and sustainability in long run. If the value of benefit of deductions like HRA, LTA, ATC, etc. exceeds the additional tax burden under the old regime, then obviously the old regime is preferable. Otherwise, new regime will result in lower tax liability. It is always better to perform a comparative tax calculation under both regimes, factoring all deductions and exemptions before making a final decision. Comment below which regime worked better for you this year and subscribe for more tax insights.